Hello there, it's me, Stephen Thomas, with yet another housing debrief. So, typically, right now, I dive into kind of what's going on in the marketplace, and then we go into our topic. However, this week we're going to focus on what's going on in the marketplace as far as the housing market is concerned. We're going to be talking about 7% rates versus the spring housing market and the sensitivity of 7% because we've been playing on both sides of the 7% barrier. And but we need to talk a little bit about what's going on with rates. And first, we're going to talk about where we are as far as the economy is concerned. Now, where we're at, we really don't have an exact idea. And the reason for that is because economists like to look backwards. And in looking backwards, they say, okay, we've been here before. So if we've been here before, where are we going? Uh, how is the economy going to progress based upon where we've been before? However, I've heard economists talk about this looks a lot like post World War II, or this looks like the 60s, or this looks like the 70s, or this looks like the 80s, and pretty much almost every decade has been covered. And that just kind of lends to the fact that nobody really knows exactly where we're at right now today. So, because we don't know where we're at, there's a lot of uncertainty in the market. And we have had inflation, it's come down, but this is much, much different than the inflation of the 60s, 70s, and 80s. I know a lot of people like to say this is just like that. It just is not. Has everything to do with the pandemic. This has everything to do with it being different than 100 years ago when we had the Spanish influenza, because myriad of different circumstances, including the internet, having computers, having smartphones. It's just a different playing field. And a lot was learned from the Spanish influenza back in the day. And they kind of approached it a lot differently. There was the lockdowns that we had around the world, as well as capital infusion into consumers' pockets around the world, as well as bringing interest rates down to very low levels to spur more consumption. And yet we had supply channels that were down. So it really rocked the fundamentals of all the charts that we looked at. And also, it really stirred the pot and caused a lot of inflation that has subsequently been coming down. The Fed, this is the Fed, they have been fighting it like crazy since 2022. They said they're going to inflict pain on consumers and businesses, yet the economy has been extremely resilient. So they've kept at it, saying that they're not going to pivot, they're not going to come down in rates, and yet they slowly but surely have changed their tune. Back in September, they were talking about one rate cut for this year. Then in December, after a myriad of different economic circumstances, they now were talking about three for 2024. And then they just recently met, and once again, they're still talking about three rate cuts for 2024. Now, they also have said that they're very data dependent. So as a result, Wall Street, financial markets, everybody has been closely watching every single data point. And the United States has just been extremely resilient. All of 2023 so far through the first quarter of 2024 and leading into today being Jobs Friday, the first week in April, we're seeing that you know what? The economy continues to be resilient. We had job openings this week. They were kind of flat. If you take a look at it, these are the big charts. They're right under 9 million. It's been kind of flat. That's a lot of job openings compared to where we were prior to COVID, which is at the left of that upper left chart. And then we had the jobs report, which came out today. This is Jobs Friday when we're recording this. And we had unemployment actually come down a little bit. And the job growth was not 200,000 like expected. It was 300,000. So it's been extremely resilient. Also, initial unemployment claims has been really low. So all the numbers are pointing to, you know what, jobs is still really strong. The United States economy is still really strong. But inflation actually has been coming down, and that's the big underlying story, which when you listen to the Fed, yes, jobs have been really important. They would love for one of these reports to be lower than expectations, so it will lead the way to allowing them to go ahead and make that first rate cut, because that first rate cut sends a message across all financial markets here in the United States. It also sends a big message all around the world. Now, what's happened with rates is I'm pointing to October of just last year. We were at 8% interest rates. And that was with no points. 8% was the highest that we'd seen since like the year 2000. So a long time ago that we saw rates this high at 8%. And it really shut down a lot of different things. The Fed didn't like it. And the equity markets didn't like it. It was a real issue when we were at 8% rates. And that meant that the bond market was also extremely high, and we have a big debt that we have to service as well. But after the Fed started to talk a little bit less hawkish, and they started to talk more conciliatory, they were more dovish, and at that point, we started to see that inflation was really still continuing to step down, and made it all the way to where I'm pointing to this green arrow. The end of that is actually December. And those were where we had interest rates that were just above 7% if you look at it. So we were all the way at 8% and just above 7% by the time we got to the middle of December, when the Fed met, released their forecast was for rates going forward in 2024. Now they were talking about 3 rate cuts. 25 basis points, which is equivalent to 3/4 of a point down total for 2024. And as a result, we saw interest rates fall considerably. And you could see the big fall. It fell from about that right above 7% to nearly 6.5%. So it really came down quite a bit. And then if you look further, then we got to the start of this year, and the economic numbers, one thing after another, CPI, inflation read, as well as all the other inflation gauges, were showing that inflation wasn't coming down as fast as it was over the prior several months. And all the economic reports were showing that the United States was still so resilient that we slowly but surely watched interest rates march forward until we got all the way to March. Then when we got to March, we got to a lot more volatility. We started to see that rates were eased a little bit, and then they climbed, and then they eased a little bit after the Fed cooled everybody's, they ruffled feathers a little bit. And then since then, we had rates that came up again. And then just most recently came down, then it went up a little bit because of today was jobs Friday. The jobs report was just a little bit too hot. So we now have interest rates again above 7%. So we've been seesawing around this 7% and below and up, and that's where it's kind of been. So we were actually below 7% for over a week. And when you have that longevity below 7%, when you have it in the sixes, it actually, you could see a material change in the markets that we all track. And so 7% just absolutely seems to be a big, gigantic psychological threshold where it changes the market. And so does 5%. We haven't seen 5% for quite some time, but let's talk about the 7%. So if you look at 7%, we actually we were at 7% all the way from the end of July to the second week of December. And then finally, it fell below 7% when the Fed met in the middle of December. And then it remained below 7%, but like I said, it went up a little bit. And then in March, it's been seesawing up and down. And most recently, as of today, it's just a little bit higher. So 7% is that psychological threshold where we actually see fewer buyers in the marketplace. And things just slow down just a little bit. Now, if you're actually a buyer in the marketplace, you're not going to notice this in any of the entry levels. You're not going to notice this out on the street, but we can actually see it in the numbers. Every time we hit above 7%, it's like the market lets off the gas a little bit. Every time it goes below 7% and gets into the sixes, we see the gas pedal go down and we're zooming a little bit faster. And if this was really to materially go way down below 6%, we'd actually see it step on the gas pedal. So if we got below 6.5%, you'd see it step on it. If we saw it go below 5%, it would be off to the races. And it's not just buyer demand that we see that increases. We actually see more homeowners coming on the market when interest rates are below 7% in the sixes. When they're above 7%, you have some homeowners that are going, yeah, you know what? I just don't want to do it right now. I'll wait till rates come down a little bit. And then they push things off a little bit. But now 7% is 5% is another story. We have not been below 5% for duration since August of 2022. And that makes a big, giant difference. As a matter of fact, at the beginning of August 2022, it was all the way down to about 5% interest rates. And that's when the Fed didn't like it at all. But because that's not what they wanted it to be higher for longer. And here they are at 5%. You could actually see a material change in the marketplace when you have interest rates that are that low. And now it's anything below 5%. It's kind of going to create that gas pedal effect where you're going to place the gas pedal down a lot further, and this market's going to zoom forward, and we're going to get more homes coming on the market, so there will be more pending sales and more closed sales, and the market will start to function and really thaw out. The more it comes that the interest rates go below 7%, the more the market will thaw. Once it gets down 6.5% or below, you're going to see a much larger thaw in the market, and below 6%, it will be a huge thaw. So there's a lot of people, there's surveys out that say people want interest rates below 5%. I call hogwash on that. You're going to see a material change in the marketplace as we get 6.5% and below, and definitely into the fives. And so where we're at today is actually right at that 7% threshold again. And but let's talk. It's at 7 points. I think it's 7.01. So we just went right above that 7% threshold. So that's where we are as of today. So we have a 7 handle as of today, and we've kind of been playing right at that 7 handle for the better part of this week. It went down below 7% for a day yesterday, and it had a lot to do with what Jerome Powell and the Fed said and kind of calmed the marketplace. So there is this issue with the spring market and 7% plus interest rates. It will be a different story if we can get interest rates below 7%. So, but first, let's talk about what happened to the housing market. But first, I've got to talk about our sponsor who brings us this program on a weekly basis. We have different sponsors, and I just want to thank Jason Thibodeau from JMJ Financial for sponsoring today's broadcast. You can reach Jason at 714-330-8263. That's 714-330-8263. He's a branch manager at the Thibodeau Morel Group with JMJ Financial. And they have this incredible mortgage podcast that they put together called the Mordeaux Mortgage Podcast. It's with Jason Thibodeau and Matthew Morel. And they're mortgage loan officers and entrepreneurs with decades of experience. They're focused to lead with a heavy emphasis on providing meaningful education and value to the consumer and real estate professionals. The industry has a tendency to be very transactional and salesy. And they're determined to help change that with their approach. Their approach is relationship and integrity first, as they found the business always follows them there. So watch their podcast as well as reach out to Jason Thibodeau for your financial needs at the Thibodeau Morel Group, JMJ Financial. You can reach him at 714-330-8263. That's 714-330-8263. Thank you, Jason, for your continued sponsorship. But let's talk now about the spring market. So here we are in spring. You wouldn't know it. It was freezing cold here in California, Southern California, and it was raining, and there was more snow on the mountains. So we've got this strange spring-like winter. So it kind of feels like what's going on with the housing market right now. Because when interest rates get above 7%, it kind of cools things down. It gets a little chilly. But once we get into the sixes, hey, you know what? It's sunshine, and we walk around with sandals and shorts and t-shirts and all that good stuff. So what happens during the spring market is that's typically when supply rises. And it's also typically when demand rises and peaks. So that's kind of what happens on a cyclical basis. Uh, the demand has really done a good job of staying there even post COVID and during COVID and years after. But as far as supply is concerned, it's been doing some funky things, and that's just because of the lack of homes coming on the market. When interest rates were so low, it was very hard to build an inventory, so it wasn't doing a normal cyclical thing that we had seen for decades prior. So, but let's talk about supply, and I'm going to talk about the Southern California supply and the Bay Area supply. So, Southern California supply, I'm pointing to this purple line, and if you look at that purple line, that was last week, 21,141. It was down 1%. Actually, we're in the spring market. The inventory went down for the week. And for that 2-week period of time, we saw it go down 1%. So it was making its way up slowly. And unlike last year where we saw the inventory continue to go down all the way through April, this year we saw it start off at a level and continue to slowly rise until we got to last week's reading. And for that 2-week period of time, it was actually down 1%. Not a giant amount down for all of SoCal. It's down 177. Last year was the blue line, and it was at 18,887. You could see that slope and how it's down. So there's the slope. It's going down, and but last year we had 11% fewer homes on the market compared to where we are right now as of last week. Now today we again we do this on a weekly basis. We crunch the numbers and we do the reports. It's every other week. So if you look at this is for Southern California, and today we're at 21,768. Actually went up 3%. So went down and then it went up. Now you could say that might have been Easter week, but when you look at Easter week last year, that's not really what was happening, because you can actually see a change in demand, and there was no change in demand during Easter of last year or the year before. This year we saw a big change, and it has a lot to do with what happened with interest rates just this week. So you're at 21,768. That's up 3%. Now in the Bay Area, that's all 9 Bay Area counties combined last week at 6,270. It was up 1% for that 2-week period of time. So it was going up like crazy. Then it slowed and only went up 1% over a 2-week period of time. Last year, the Bay Area was at 4,917, which was 11% fewer than where it is right now today. And if you look at it, actually, that was as of last week, so it was 11% fewer than as of last week's data point. But today, it's at 6,779. So we had interest rates for that entire week, that prior week, that was at less than 7%, and we were spending a lot of time for the second half of March below 6%. Then all of a sudden, we bumped up above 7% this week, and now we have an 8% rise in the active inventory. So we see this rise to 6,779, which is up 8%. Now we're going to talk about demand. On the demand side of things in Southern California, you could see that last week we were at 11,343. It was up 3% for that 2-week period of time. So the slope was pretty good. I mean, it wasn't like prior years. You could look at those prior years. That the orange line is 2022. When the first half of the year when interest rates were still really low. And then the green line is the 3-year average prior to COVID, and the red line is 2021. But last year we were 11,201, which is 1% less. So there was actually more demand right now this year versus last year, comparing last week to the prior year, that same week. Today, 10,881. Actually, demand went down. And like I said, this has a lot to do with that change in interest rates. Now, I could see it in the data. And when I see it in the data, you can't, like I said, feel it in the streets that much, because when you're in those entry-level ranges, it still feels extremely hot, and you can't really tell when in the entry level when there's 8 offers on a house versus when there's 11, 12 offers on a house. It just feels still really hot, and you're still competing against a lot of people. So that's why you can't materially see it in there, but we can see it in the numbers because things slow down ever so slightly. And that's exactly what we're experiencing. We're experiencing in the Bay Area. So it went up for a 2-week period of time. It went up like crazy, up 12%. 3,965 was last week's reading. Last year, the reading was 3,743. That's down 6%. So it had been climbing at a 12% rate. And then today we're looking at 3,740, 3,000. I don't know why it says 0%, but that's funny. That's down. It's down slightly, not down, not 0%. It should say 3,943. So my error, 3,943, not 3,743, but 3,943. Now 3,943 is basically almost the same as where it was last week. But as you could tell, it was zooming up higher. Then all of a sudden, it took a big giant pause. This has everything again to do with interest rates. When interest rates are climbing up higher, it'll slow things down a little bit. So we see demand was going up, and then all of a sudden flat line. That is because of has a lot to do with rates. And you can see, so how fast is the market moving? What is the speed of the market? That's our expected market time reading. It's not days on the market. It's based upon supply and demand. So it fluctuates based upon the fluctuations in the market, which is a key data point that we created so that we could get the true sense of the velocity of the market. Days on market will not give you that. So days on market is not that great of a statistic. I've never really liked it. It's good to know how long a home's been on the market if you're a buyer looking to purchase. And the longer you've been on the market, if you're a seller, you know what, it might be your price. So, but as far as this overall velocity, we're looking at the overall number of available homes and what demand velocity is right now today. That's pending sales activity, the last 30 days of pending sales activity. So you look at available homes and pending sales activity, and those changes in those two will give you the different speeds in the market. And since we're playing right at that 7%, we're seeing this big change because it's been playing up and down above and below 7%. And you could see that the expected market time in Southern California was at 56 days last week. And you can see it actually was getting better from where it was 2 weeks prior. Last year was at 51 days at the same time period. That's the blue line. And it even actually dropped a lot from here because last year we had interest rates that were materially less than where we were than where we are right now today in today's market, 7%. It was a lot lower. And today we're actually at 60 days. So it went from 56 days last week, 56 days to 60 days this week. So it's actually slowing. And typically what happens during the spring market is demand is rising and so is the inventory at about the same pitch. So you actually get this expected market time that kind of remains the same. It's kind of flat. It can go up a little bit or down a little bit, but it doesn't fluctuate 56 days to 60 days in a week's period of time. And that's just that velocity change with interest rates playing right at 7%. And if you look at the Bay Area, the expected market time last week was at 47 days. Last year was at 39 days, the blue line. And today it's actually 51 days. So went from 47 to 51, very similar to Southern California. So all of a sudden, this big slowdown in this metric, and this has everything, once again, to do with rates. There is a real interest rate sensitivity, a very big sensitivity. So it's kind of like consumers and buyers and sellers have drawn this big line in the sand. And that big line in the sand is 7% rates for a lot of people. That doesn't mean that the market stops. It just means that we have fewer homeowners that are coming on, and we have demand that slows a little bit. We have homes that linger a little bit longer on the market because of where rates are at. Once we finally do get rates that come down below 7% with duration, this will change the marketplace completely. And a lot of people have asked us where it's going to be, when it's going to be, and it looks like it's going to be later this spring or summer over the course of quarter 2 or quarter 3. Still could possibly be as even later than that, where we get towards the fourth quarter, more towards the fall and winter. So the Fed is very, very data dependent is what they're talking about. But the biggest data point that they care about is actually they look at they look at the PCE. That's one thing that they actually like the best. That actually just came out recently, but it's CPI will kind of set the tone. That's Consumer Price Index. It's just a basket of goods. That comes out first at the beginning, towards the beginning of the month. And guess when we get this CPI reading? Next week. So we're going to get a big pivotal point, and this will really change the market. This is what the markets are waiting for, is this CPI print that comes out next week. So we're going to look at CPI next week and PCE at the end of April. So hopefully for the real estate market to thaw, so more buyers can buy and more homeowners will come on the market, and we could get a little bit of thawing in the real estate market so that more people can buy and sell, which is kind of what we're supposed to do. It's not supposed to be a frozen market for those people that are rooting against the market. It's not changing values. It's just freezing the market so a lot of people can't consume. They can't buy, they can't sell, or they won't sell. So consumer price index, this is going to be very important. So we'll be watching that data point. Stay tuned for that next week. Hey, did you like what you heard today? If you did, like the video, subscribe to our channel. We'll be bringing more of this kind of great content to you on a weekly basis. And we also have a ton of reports that you can subscribe to. Go to reportsonhousing.com for more information on that. If you're a real estate agent, tap into this. We focus on different counties. Each county has its own report, and we're going to launch Phoenix and Vegas in May. And the most recent one that came out is called The Temperature of the Market. And it's how to gauge what's going on in the marketplace. What is the temperature of the market? How do you tell when it's all of a sudden going to be hot or cold? And where are we at right now? And what are the trends? That's what we talk about in this latest report. And if you'd like a free month and you want to subscribe, go to reportsonhousing.com. And when you subscribe, utilize the coupon code RATE. So I appreciate you, tuning in again to one of our housing debriefs. Hope you have a fantastic finish to this week. We will be reporting on what's going on in the housing market next week. So we will see you